following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, those marching boots and those pounding drums mean it is time once again for Options Bootcamp, a little program where we take you, the raw options recruit, and then we break you down savagely, indeed viciously, and then proceed to rebuild you into seasoned options veterans. My name is Mark Longo from theoptionsinsider.com, as well as a little old thing some of you out there may be familiar with called the Options Insider Radio Network. Keeps growing, keeps setting new records all the time. We are very thankful to all of you out there in the listening audience who are contributing to that, including making Options Bootcamp just the runaway hit that it has become there. So keep downloading, keep streaming, keep telling your friends. We love doing it, and we love that you guys love it. So it's a big love fest over here on the old Options Bootcamp drill instructor squad. And speaking of my squad, I am not alone on this show, not by a long shot. I am joined by the dynamic duo, the Wonder Twins themselves. Starting off with the man beaming in from the great city of New York. You know him, you love him as the Options Major Domo over there at SogoTrade.com, Mr. John Critchley. John, welcome back to the show, sir.
Hi, folks. Always a pleasure. Great show today. Looking forward to it. Very excited.
Which of the Wonder Twins would you be, you think, John? Would you like to be the one that becomes the water, or the one that becomes the animals, or maybe the monkey? Your choice.
I don't know. I'll give Dan the choice. Dan seems to like things like that, so I'll give him the choice.
You know, if I had to pick, I would go with Gleek the monkey. That would be really fun.
He knows the name. A scary, scary thing, but yet also funny. That is, of course, listeners, one Dan Passarelli. He is the other major domo we have on the show, coming to us live from Market Taker Mentoring HQ in sunny and scenic Frankfort, Illinois. Mr. P, welcome back to the show, or should I call you Gleek for the rest of this episode?
I guess I'll go with Mr. P.
I just rediscovered that name recently as well. My little guy is starting to rediscover all those old Super Friends cartoons, so I learned it myself. But I am surprised, and maybe not so surprised actually, that you do know the name as well. That's pretty funny. All right, and with the Wonder Twins assembled and one extra monkey on our hands, we shall dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, everybody, that parade ground music means it is time for the old options basic training segment. This is the part of the show where we take you, the listener, and we introduce you to some basic options concepts and then teach you how to implement those into your trading. And a lot of you, a ton of you, have written in over the past few weeks in regards to the shows we did back on July 19th and August 6th. Those are Options Bootcamp 26 and 27, Calendar Spreads, and then Calendar Spreads Part 2 of the sequel. There's been a lot of people writing in asking questions and asking for additional shows about additional things. So we knew we had to go back to this topic and revisit it. And one of the things that many of you really seemed interested in were taking that calendar spread concept to the next level. If you recall, on the last episodes, we discussed primarily the very simple, very basic, very straightforward calendar spread, the simple horizontal 1 month calendar spread. That was, of course, let's say you did a call horizontal calendar spread, so you bought a call on the at-the-money call in the front month, you sold the at-the-money call in the second month out option, and there you had your spread. And we walked through various scenarios that would unfold if you traded that and why you might want to do that. And if you missed those, of course, I encourage you, go back on our website, theoptionsinsider.com, or on Sogo Trade's website, or in iTunes, Stitcher, or wherever you find this program, and listen to those episodes, because they will pave the way nicely for these, what we're going to talk about here today. And so today we're taking that to the next level. I know we talk about basic concepts here on this show, but we're going to tweak them a little bit for today, get a wee bit more advanced, and talk about the next level of calendar spreads, and that is the diagonal. Now, what is the diagonal? Well, remember we talked about horizontals before? This is just tweaking that a little bit, and the name is pretty self-explanatory. So if you're talking about, let's say, in the previous scenario, you were buying and selling the at-the-money calls 1 month out, so you had this horizontal spread. Now let's say we tweak that a little bit, and you buy or you sell. Let's say you sell the at-the-money call in the front month, and then instead of buying the subsequent at-the-money call in the 1 month out contracts, you roll it up a little bit and you say, I'm going to buy a 5% out of the money call instead. And so now instead of buying a simple horizontal calendar spread, you've bought a you've bought a diagonal calendar spread. And you can just see from the strikes alone where that name comes from. There's that diagonal line between the two. And so it's a little bit different. It may seem similar, and it is in many ways, but the diagonal is a little bit different beast, and it gets a little bit confusing when people start talking about these things and why they should do them, why shouldn't they use them, how they differ from a typical horizontal calendar spread. There's a lot of reasons you probably at home could think of why you might want to use these trades. You might think, well, I might have a little bit different outlook on the underlying than I do with a simple horizontal spread. Remember, in the simple horizontal spread, you wanted it not to move at all, and so you wanted it, particularly if you were buying that spread, so you wanted it to stay right around that strike. You may have a different outlook for the farther off months with a diagonal spread. There's a lot of reasons you might want to do these. And I know, Dan, when you're working with your various clients and your mentees over there at Market Taker, you guys love the diagonal. It's kind of one of your go-to spreads. So why don't you walk our listeners through what you tell your clients when they come to you and ask you about diagonals. Why would you use a diagonal versus a simple horizontal spread?
Well, there's a number of reasons. I mean, for one, diagonals can be put on a whole number of ways. I guess just to kind of start out pretty general before getting into real specific strategies, usually for me, the reason why I would tell people to take a look at a diagonal is because usually you can get better theta situations. When you trade a vertical spread or a time spread, there is a theta component. More specifically, let's just be even more general than that. Time is a very, very important component. I talk to a lot of amateur traders and they say, I bought this call spread and then 3 hours later I sold it. And I said, well, how did that work out for you? I made 10 cents, on a $10 spread. It doesn't really work because of that natural time component that's embedded in it. And so in order to really maximize your chance of success and do the best job you can with a time spread, a horizontal spread or a vertical spread, you really, really need to focus on all the benefits you can get out of theta and really just squeeze every drop of theta you can out of it. And a lot of times, maybe not always, but a lot of times, you can improve a time spread or you can improve a vertical spread by doing a diagonal, this sort of hybrid between the two. It's kind of, in many cases, it can be the best of both worlds between those two.
Can I mention one thing? That was a great explanation by Dan and Mark. And the goal of the strategy is, as Dan pointed out, is to take advantage of the theta or time decay or erosion. But another big advantage is that you can take advantage of some implied volatility skew across the strike prices. Remember, you're selling the at the money, the call, and you're buying a out of money call, farther out of the money call. And normally, as we've gone over many times in other podcasts, you'll see what they call skew. So the out of the money calls will have a lower implied volatility. And again, that's because the most popular strategy, as we all know, is the covered call. Therefore, there's more supply for out of the money calls, and the demand goes lower, and the market makers lower the price. So the out of money calls tend to have a lower implied volatility. So you get some value there too. So not only are you taking advantage of the decay, as Dan and Mark say, but there's also you can take advantage of some implied volatility skew, which is very important.
And there's a lot of reasons why you might want to do a diagonal, and it may not always be the typical scenario that you think of, listeners. For example, if you listen to our most recent episode 28, we talked about some tips from the pros, some pro tips for trading options. And one of the ones I mentioned in that episode was swapping out a leap, a long-term in-the-money call, for the underlying when you're writing covered calls. And that, when you do that, when you buy a long-term, typically in-the-money call somewhere farther down the option chain, and then you're turning around and writing front month, usually maybe at the money, maybe 5-10% out of the money calls, a covered call essentially on that. What you've done is taken that stock covered call position and swapped in essentially a diagonal time spread. You have a long-term in-the-money call, which is, like I said, farther down the option chain, and then an out-of-the-money typically call that you're writing against it very much in the near term. And that, again, gets back to what Dan was talking about, maximizing your theta and also using your capital more efficiently. So there's a lot of different ways that diagonals can be used, and that's just one great example. If you're having a hard time thinking, well, why would I want to do this? Why would I want to do these crazy diagonals? That's one perfect example of a scenario where you can swap in something that you're already doing right now. You're already probably writing covered calls, a lot of you out there, and just swap a long-term call in there. It doesn't have to be a couple of years. It could be 6 months. It could be maybe a year, whatever you're comfortable with, wherever the premium to parity works out for you in your favor. And then you could swap that in for that covered call and start to experiment there with how these diagonals work for you. There's a lot of great ways that you could really start implementing diagonals in your trades. Now, Dan, you mentioned the Greeks. We mentioned theta, really, which is a very important Greek for a lot of what we talk about here on the show, because theta, of course, is time decay. We talked about the Greeks a lot on the recent episodes, and we talked about the horizontal spreads. Let's walk our listeners through, really, the basic Greeks here of a diagonal. They're pretty similar for the most part, but give our listeners a refreshers of how these Greeks, how you look at the Greeks, how they perform with a diagonal versus a simple horizontal spread.
Sure, Mark. When Mark tossed it to me this last time, I kind of focused on theta, and actually John did a whole lot more due diligence by mentioning that, really it's not really just the theta, it's also the volatility component, and to be fair, there's also this delta component. Diagonals are about maximizing each of those. Okay, so let's start out looking at this as an alternative to a vertical spread. I mean, one could consider a bull call spread kind of sort of an alternative to a covered call as well, right? We have a long stock
I refuse to consider that. That's just not in my wheelhouse, sir.
Well,
Try
you know
again.
what, Mark? Would you like to sign up for a class here at Market Ticket?
Maybe I should do that, yes.
Well, work with me on this one. Consider for a moment that one could buy a call as a proxy for owning the stock. And then one could sell a call to finance the purchase of that call. So, okay, to be fair, and, kind of to Mark's, joking around here, there is a difference, and you kind of do have to expand your mind a little bit to kind of appreciate the similarities and the differences. A call is certainly not a complete proxy for owning the stock. Why? Because a stock is pure delta. It doesn't have a time or a volatility component, but a call does. And so you've kind of got those things working against you when you buy a call. With its straight vertical spread, that's why, it's one of the motivations anyway, of why somebody would trade the vertical spread instead of the long call, to offset some of that time decay, to offset some of that premium over parity that you pay for the call. That's a really quintessential difference between a long call and owning the stock. So the bull call spread kind of helps you a little bit to hedge off some of those issues. But the second thing is that, okay, great. I can sell a call to hedge off some of the time decay, to hedge off some of the premium over parity, but I want to do that as efficiently as possible. So if I sell a shorter term call, I might be able to get a higher rate of theta. And if I think that I'm planning on holding this bull call spread for maybe 2 months, if I sell a 1 month call against the long 2 month option and then sell another 1 month call after they get against that same 2 month option, I might end up taking in more premium over parity. So the first Greek that really can get exploited really, really well is theta. Now, another reason why one might consider a diagonal from a Greek's perspective over something like a bull call spread or a time spread is also delta. If I'm trading a time spread and I want a directional component, I can do that. I think we talked about that on one of our last shows. I can set up a directional time spread. If the stock's at 50 and I buy the 55 strike time spread, it's directional. The stock needs to be at 55. But if I sell the short-term 55 call and I buy a longer-term, say, 45 call, now I've got a very directional time spread because I have a much bigger delta because I'm using an in-the-money option as my long instead of an out-of-the-money option. So I get that same theta benefit. I'm playing it smart with the time spread, getting that theta benefit, but I'm bumping up my delta benefit. And then the final Greek, of course, is, as John pointed out earlier, comes from volatility. It's our vega benefit. A diagonal is a type of time spread. It's in that time spread family, I would say anyway. One of the advantages of any time spread, any option spread where there are 2 different expiration months, is that you can play off that term structure of volatility. You can buy the lower volatility option and sell the higher volatility option at the same time. That is kind of the premise of the second book that I wrote, The Market Taker's Edge. It's all about getting that volatility benefit. It's all about getting an edge. I mean, it's very, very, very much akin to how casinos operate. Casinos aren't in the gambling business. They're in the edge business. They're in the statistics business, the numbers business. Every hand you play of blackjack or craps or roulette, the house has a slight edge. The more hands they play, the more money they make in the long run. That's how option trading should work, and that's how, for you, option trading can work, is by using volatility to get an edge on your trades.
There's so much to talk about there with the Greeks and the diagonals. And I think you're right. I think for a lot of our listeners, that's why I hit on that covered call scenario. I think for a lot of our listeners, the easiest point of entry, the easiest way for them to wrap their heads around this type of strategy, the diagonal, is that theta maximization component. That scenario you outlined, the one I outlined, where they're using the very near-term call to maximize the theta benefit to finance a longer-term call. In fact, that's one of the reasons why the weeklies and so many of the other short-term options that have been launched now have become so popular. They really feed into this scenario, whether you want to use a simple horizontal spread to do that, you want to buy a longer-term call and finance it by selling the nearer-term options on that same strike, or maybe you want to buy Dan's example, buy an in-the-money call, finance it by selling some out-of-the-money calls against it, whatever way you want to construct it, maybe the other way, maybe you want to go out of the money the other way, whatever floats your boat in this particular scenario. I think if you can approach it from using that theta portion of the trade, then you're really, I think, getting at it from the right perspective. Of course, as Dan mentions in his book, and as a little bit more sophisticated traders start getting into diagonals, they start to look for some of the other things we've outlined in here, and like what Dan was just talking about, trying to find those opportunities to exploit. And that's where we start getting into, well, why would you do a diagonal as opposed to a simple horizontal? Well, let's say you're looking at a name like, let's say maybe an Apple has been a big culprit of this in recent years. Not so much recently, but a year or two ago, this was certainly the case, where people were so strongly beholden to Apple going into earnings that they would bid up that vertical call skew, particularly to the upside, like it was just candy. They would buy all those calls and keep those calls very, very expensive. So if in that scenario, if let's say you wanted to, and that was the front month, let's say you wanted to finance a longer term call position in Apple, instead of selling the at the money, you can get much more bang for your buck from a volatility perspective by actually selling the out of the money call in that perspective and maximizing your theta component. Of course, you can also leg into verticals and ratios for very good prices as well. There's a lot of ways you could exploit that particular scenario, but that is one example when you might want to take the volatility component of a diagonal and exploit it to your benefit. Now, John, when you guys over there at Sogo are talking to clients, when clients call you guys up to say, hey, I'm thinking about a diagonal in this, what are some of the tidbits, some of the advice you give them about diagonals in general, as well as when they should really want to use a diagonal versus some of the other strategies we've outlined here on the show, like your simple horizontals, like your verticals, and all that good stuff?
Yeah, sure. I mean, I always try to break it down really into the strategy being a two-step strategy. I mean, when you first put it on, you're going to sell the at the money front month, and you're going to buy the at the money back month. And what you want to happen is you want the stock to be neutral to, let's say, a little bearish, and then you want this front month option to expire worthless. And normally, when I recommend it, or if I do it myself, I want to put it on for a credit or even for a small debit. So now once the front month expires worthless, let's say, now I can sell the back month, the same strike now. I can leg now into a vertical spread, and I'm putting it on for a tremendous price, for a great price. So it's I think as a cross between a long calendar call spread and a short call spread. First, you have as a time decay play, as Dan said, Mark said, you want the front month to decay to nothing, to go away, and then once you sell the second call with the strike with the same out of money strike price, now you have a short call spread. So you want the volatility to be high, very, very high in the beginning, but you don't want the underlying to move too much. So it's a little bit of a paradox, a little bit of a contradiction there. But that's usually what I advise customers, that they kind of try to break it down to two different parts. And it's not like a really short-term trade. It's a little longer-term based.
And when we're thinking about diagonals, they come in many flavors. We're talking about the straight-up call or put diagonals, but a lot of times, and probably one of the most often use cases we see for diagonals actually kind of straddle the line a little bit, where they move beyond the traditional diagonal landscape into crossing the call-put boundary. We see a lot of times people, when we're talking about unusual activity on some of our other programs or writing on the optionsinsider.com, we'll see a lot of people coming in buying out-of-the-money calls, or a lot of times perhaps out-of-the-money verticals, if they're a little bit more savvy, and then they're financing that with perhaps a put right, usually in a different month, as a way to finance that sort of vertical call spread or that sort of out-of-the-money call. So we see a lot of people legging into what are essentially, in many ways, time risk reversals at that point. So they don't really fall into the traditional diagonal definition, but they are very popular. And another use case that might be common for you, the listener, you say, hey, I like these out-of-the-money calls by this month. But in the meantime, I think the stock's going to rally to that point by there. And of course, we talked many times about the dangers of out-of-the-money calls. So maybe you want to swap in a vertical instead. I like this out-of-the-money vertical, or the at-the-money, out-of-the-money vertical and XYZ underlying. And I'm going to buy this 6 months out. But wow, that's a lot of decay. That's a lot of time to sit on this position. What can I do in the near term to really start juicing this up a little bit and get a little bit more income and offset some of the price I paid, some of the premium I paid for this vertical? Well, maybe I'll look to the downside, and I'm kind of comfortable on this name below this level. I wouldn't mind owning this stock, so I don't mind writing a near-term put against that. So now you've legged into what is essentially a time risk reversal, and if the underlying drops, obviously you own it at that price, but if it stays where it is or continues to rally, your vertical pays off and you finance a portion of it. And that is a very, very popular use case for a little bit more atypical diagonal spread, but still a very popular strategy that people talk about and tend to lump in together with the diagonals. I hope I'm not blowing too many of our listeners' minds by getting a little bit outside the diagonal box here, but when you start getting into diagonals, there's all kinds of ways you can go with them. I'm trying to just give you a sampling of the different ways you can implement a diagonal. Speaking of sampling, I know, Dan, you talk to your clients all the time. They come to you with crazy horror stories, and some good ones, about how they've used diagonals. We don't want to identify anyone here, of course, but give us maybe some general or some specific things you've heard from your clients, maybe an example you've heard, or some to-dos or not to-dos that you've heard from some clients that you want to pass on here to our listeners.
Well, you know what? In your introduction to the show, Mark, you said, well, why would I want to do something crazy like this? And the bottom line rule of thumb that I tell all my students is keep all your option strategies as simple as possible. So, you're coming out of the gate, you learned what a call is yesterday. Well, you're not trading diagonals. But once you have somewhat of a grasp on options and you understand spreads, then sometimes these diagonals that are somewhat more complicated become necessary to trade in order to have on an effective trade, to exploit a particular market scenario efficiently and effectively. So some of the horror stories come from some of these guys come to me and they've got on they're long these out of the money calls in the Septembers, and then they're short some of these in the money calls in the weeklies, and then short some more in the money calls in October, and they've just got all these crazy different strikes on all over. It's like an octopus spread because there's 8-10 legs to it, and those sort of diagonals, that is a horror story, and there's almost never a good reason to do that unless you're a market maker or some sort of arbitrageur where you're really trying to accomplish something very specific. As far as horror stories go, that's really where it stems from, is thinking, oh yeah, I heard about this diagonal on this podcast. I'm going to go trade them. I'm going to create this whacked out, crazy diagonal with all this stuff going on. No, keep it as simple as possible, but look at it like I talked about earlier when I talked about the Greeks, and like Mark and John have been talking about this whole time. Use it when it's in your best interest. Use it only when it's in your best interest, where you are putting on a smarter, better trade that more effectively takes advantage of the market scenario.
Now, I would have to imagine for a lot of our listeners to this show, one of the ways they would perhaps stumble upon diagonals would be not in the initial setup. They wouldn't come to the trade and say, I'm going to put on a diagonal spread now. They might buy X call that they think is going to work in their favor, and they might have on their positions for a while. And then the underlying starts to rally, and then the time passes a little bit, and then they may turn around and say, well, this is interesting. Now I might sell this other call kind of against that as a way to leg into a spread and probably be a little bit farther out of the money because the underlying has rallied a bit. And now what they've ended up doing, perhaps not without even realizing it, is legging into a diagonal like that. So I think for a lot of our listeners, that's probably where their first scenario, or hopefully not in the horrible octopus scenario that you outlined there, Dan, where someone just went willy-nilly selling calls left and right to finance another position and it ended up coming back to bite them, but in a more measured approach, let's hope. But something like that, where they put on an X position and then it starts to run and starts to move perhaps in their favor, and they start to saying, what else can I do aside from just liquidating the position that will help lock in some profits, take some premium off the table, and put in a better overall position for me. And that's where perhaps almost by accident they will stumble into a diagonal. Now they'll say, wait a minute, I have this strange diagonal position on. How does that perform? And hopefully they'll come back to a show like this and be a little bit more well-versed in the topic. But that, of course, gets to I think, one of the other salient points of when you're doing diagonals is the strike selection. A lot of people wrote in with questions about, strike selection. How do you choose your strikes for horizontals? How do you choose your strikes for diagonals? And, there are a myriad different factors you can literally factor into this when you're making this decision. We've outlined already the time decay factor, which in the scenario I outlined, buying the long term in the money, so you're below the at the money, selling this, let's say 5% out of the money. That's usually a very common covered call scenario. That's pretty much a very straightforward strike selection type factor. And we start getting into some of the things that John outlined, like the implied volatility skew, that gets a little bit more nuanced, and that usually requires a little bit more nuanced trader to really understand those, to be able to look at the term structure. Remember, we talked about term structure before on this show. If you don't remember it, go back to our episodes on volatility, where we discussed the term structure of an option being looking at the various individual months and a graph of the at-the-money volatility in each of those months. And you can see that makes a nice little chart, and you can start to see how the term structure of that individual name plays out. Now, when you look at that and you also compare it to the individual volatility skew of each of those months, then that starts to create a better picture for where there are distortions, where there are places to take advantage of using spreads like this. And that's one of the reasons why we got into diagonals, because very rarely are you going to have a scenario where one at the money is really bid up and one at the money is very cheap, and therefore you can do a simple at the money horizontal calendar spread. That's very rare. Usually, to exploit these types of discrepancies in the skew or in the term structure, you really need to put on some sort of diagonal, because you're going to have something very bid in the put wing, something very offered in the call wing, or vice versa, and you need to go across the option chain to really take advantage of that. So that's a scenario where you might want to take advantage, for the more sophisticated listeners, take advantage of the skew and other things that we're going to talk about perhaps in an upcoming episode in a little bit more detail. Don't have time to really get into those here, but that's another example of when you might want to start thinking about a diagonal. Either you have this position working for you and you're writing options against it now once it's gone your way, or you have that income generation strategy we've outlined, or you have this, I see two very clear discrepancies and it's time to sell the very bid up term structure, the very bid up volatility skew, and I'm going to buy the cheaper one. And that gets into what we talked about last episode as well, or actually 2 episodes ago, about viewing the spread as a whole versus the individual legs. For a lot of our individual listeners out here, I think the individual legs will be easier to wrap their heads around, but once you get a little bit more sophisticated, you're starting to exploit discrepancies in the term structure and in the volatility skew, then you want to start thinking about spreads as a whole, and how they perform, how the individual volatility components of each leg performs, how they combine, so that spread as a whole, how it performs versus just where the underlying moves, and how my spread fits into that calculation. So there's a lot there. John, anything you want to add there for our listeners on when we're talking about strike selection, when you're talking to them about, let's say, legging into diagonal or using a diagonal from the outset, perhaps around earnings? I know one of your favorite times. What do you tell people when they contact you about, hey, I'm looking into getting into that time spreads, I'm looking to get into diagonals? What do you walk them through for some strike selection criteria?
I mean, the basic thing is, actually, that question is $1 million question, and there's really no right answer. I mean, it really depends upon your outlook on the underlying, the events that are happening. And my advice always is, what's your outlook on the underlying, short term, long term. And I like to usually put these trades on myself. Like I'm going to do them. I said before, I like to put it on for even, a credit, small debit. I like to be money neutral, so to speak. And so that's one way I look at it. And one thing is, don't get sucked into the idea, even though I'm always talking about it, but skew so much as far as the out of the money calls. They're really a sucker's bet when they're so depressed. If you see the front month very, very much elevated and the back month hasn't gone up that much, that might be a sucker play to put one of these trades on. So, just be careful. These trades, as we've mentioned, are really for seasoned veterans. You have to make sure, I tell the customers, that you really understand verticals first. Then once you understand calendars next, and then when you have a grasp of these two pretty well, then you go into these trades. But unless you know the first two really have it down pat, these trades are very tricky for even the seasoned pro. So just be a little careful jumping, into the deep end of the pool on these trades.
Yeah, let me just kind of jump in here and highlight things that John and Mark just got done saying. I mean, John said, well, if you see this, blah, 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 this might be an opportunity. Mark said the same thing. He was gave a great example about Apple. Hey, when the implied volatility is higher in the calls, which is a kind of rare scenario, you jump in and do it. And all that's very telling about really not just diagonals, but what's at the heart of option trading altogether. All good option trading is opportunistic. Good option traders are hunters, not gatherers. When I see the guys who have just learned enough about options to be kind of dangerous, the problem they fall into is they start trading the same strategy every week, every month, because it worked a number of weeks or months in a row. So, hey, it must be great. And then sooner or later, it works until it doesn't work and it blows up in their face. Diagonals are kind of for the big boys who have made it past that level and understand that when I put on a trade, it's because I see a specific opportunity. I'm not just going out there and doing the same thing month after month and hoping it keeps working out. I see a specific opportunity. And one of those opportunities, here's my example, my strategy contribution to this discussion today, is a strategy that's I referred to in my first book, Trading Option Greeks, as cheaps and deeps. When a stock gets really, really cheap, you can use a deep in the money call as a proxy and finance it with selling a short-term out of the money call. It really is very much akin to a covered call strategy in this regard. And the reason why it works when it works is because of the volatility disparity. Because a lot of times, take any stock, and, there's a million stocks. I was talking to Mark with this about before the show, and he said, oh, yeah, it sounds like something that's going on in BlackBerry right now. Sure. Anytime you see a stock where, maybe it was a $20, $30, $40, $50 stock, and now it's a $10 or $20 stock. It's hanging out in the teens. It lost 50 to 60% of its value. And you're looking at it, you're reading the news, you're looking at the chart, and you're saying, I don't think this sucker is going to recover too quickly. I think, if anything, it's going to make a nice, slow, steady recovery. There's an awesome opportunity, because you know what is probably going on? Probably the front month volatility is super elevated, and the back month volatility is low. Typically, when you see these big violent moves downward, that's what happens, right? Front month vol gets bid up, the back month vol stays cheap. So there's a great opportunity to buy a deep in the money leaps call. And, the leaps deltas end up being closer to 50. They're less extreme because there's so much time. So maybe a 70 to 80 delta leaps call. So we're talking pretty in the money. And then you sell a weekly or a monthly or one of these serial weeklies out of the money options that's set at a strike price just as high as you think the stock can get to by expiration. And then when that option expires, you roll it. You sell another one. And then when that option expires, you sell another one. And what typically happens after about, 5-6 rolls, you own that long-term leaps option for free. And what you can do is either keep milking option premium by selling those shorter term options to complete your diagonal, or just hold on to the long-term leaps call and know you own a free lottery ticket. And, if the stock does rebound after a few months, you're in great shape. So that's one of my favorite diagonal strategies, and it's very opportunistic. This isn't like, oh yeah, every week I do that on the SPX. No, that doesn't work. You wait for these opportunities to arise, and you say, I know how to play this. I can see the volatility's high. I can see that I get the advantage of buying the cheaper volatility here and selling the higher volatility here. And I'm going to sell this strike at a price where I think it'll expire. And I'm going to roll it, and it's going to pay for it. And it ends up being a very, very smart, opportunistic strategy.
That was one of my notes I made, and Dan really hit the nail on the head there. A lot of times with this strategy, as we said before, it's a two-part strategy. And when the front month option expires, let's say it expires worthless, and if you have put this on for, let's say, even or a little credit, a little debit, you have two choices. You can now sell the same month the lower strike call and put a call spread on, or guess what, folks? This is what I do a lot. I don't do anything, and as exactly as Dan said, now I own the out of the money calls, in the back month for free, basically. I mean, it's like a lottery ticket. So that's one strategy I love to do. I guess I'm more of a gambler, but that's another strategy you can do too. You can do this trade, and if it works in your favor, you don't have to put a vertical on. You can just do nothing, and now you have a call that you, in essence, bought for free.
Yeah, that's, like I said, that's why I've outlined that strategy several times here. It's one of my favorites, and I think it's a very easy to grasp type of strategy for a lot of our listeners out there who, a lot of them are already out there running with covered calls, so that's a pretty much a no-brainer adoption for them to add that to their trading scenario, and that takes advantage of all the other things we hit on the show in the past, using your capital more efficiently, maximizing the Greeks, all the things we like to preach here to our listeners. And you know what, listeners, we can keep going on about diagonals for a long time, but we got some great listener mail questions about similar topics, so we're going to keep on rolling right on into the mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, welcome to the mail call segment. Of course, one of my favorite parts of the show, because this is the point where you, the listener, get your chance to sound off and chime in and let us know what you're thinking and what's at top of mind for you. And a lot of you guys wrote in with all kinds of calendar and diagonal questions, so thanks for those. Keep them coming. First off, we have the tail end of a question someone submitted for another show, but added this extra part for us here on Bootcamp. It's from Richard D., and he says, I think a whole Bootcamp show on skew could be very helpful. Thanks. And I agree with you, Richard. That's why I kind of touched on it at the earlier segments. It's kind of hard to fully do diagonals without having first done skew in depth. We've been toying with the idea of doing a skew show. I think that's definitely on the docket for us coming up in the very near term, so stay tuned for that. That's why we wanted to hit on diagonals first, but when you're getting into strike selection and things like that, it gets a little bit complicated if people aren't familiar with skew already and what we're talking about with an inflated call wing and, deflated put wing and vice versa. So we need to probably go back and really run through those at length as well. We're getting so many people just firing off about the calendars and questions about those that we needed to get in diagonals too, because there's just so much that people want to know about those types of spreads. And speaking of diagonals, we have a question here from Mr. Hawkeye 6, and he writes, I love the pair of calendar spread shows. Well, thank you, Mr. Hawkeye 6. He goes on to say, can you make it a hat trick and have a show on double diagonals and double calendars? I'm especially interested in hearing about selection criteria. What makes a good candidate, criteria for strike selection, when to pick a double diagonal versus condor versus iron condor, etc. It's a great question, Mr. Hawkeye 6. We touched on it already. We gave you kind of the hat trick you wanted. We gave you the show on diagonals, but what you're looking for is even a step beyond what we were just talking about. This is, of course, the double diagonals. And this strategy really gets into the heart and the essence of one of the things we talked about on the show many times, where retail tend to be more directionally focused and the professionals tend to be more volatility focused. And these types of trades, the double diagonals, are a direct address to that, because they take away a lot of the directionality of the things we're talking about here. We're talking about, let's say, typical horizontal call spreads, or we're talking about diagonal call spreads or diagonal put spreads. There still is a directionality to those types of trades. But what if you went crazy and you decided to do both sides? You decided to do the call side and the put side in one diagonal. I know I'm blowing your mind with this, but just go with me for a second. What if you did that? What would that be like? What would we even call it? What do you think that trade would be called?
That would be crazy, wacky stuff, Mark. I couldn't even imagine it.
I'm off the deep end here. Dial me back, Dan. Dial me back.
Indeed. Well, actually, I can imagine it, and it's actually not a too uncommon strategy. Again, like any of these diagonals, it's not for the newbies, but it is a strategy that's in common practice among many sophisticated income traders, and it's called a double diagonal. The best way to look at a double diagonal is, well, first let's explain what it is. So it's very different than what I described earlier when I was talking about diagonals. Here's what it looks like. It's a long-term, low strike put, very out of the money. And then at a somewhat higher strike, but still out of the money, it's a shorter term put. Okay, so can you visualize that as a diagonal? Then there's another side to it. A higher strike above where the stock is trading, one would sell a short-term call. Same expiration month as the short-term put. And then at a yet higher strike, further out of the money for this long call, one would purchase a call that has a longer-term expiration, the same expiration cycle as the longer-term put. Now, I appreciate the fact that this being a radio show, there's some people listening saying, what is this guy talking about? And you're like rewinding on your iPod 12 times. Hopefully you're not driving while you're listening to this, or running or something, or biking. It's a little sophisticated. Let me give you an easier way to visualize it. Think of an iron condor. Okay, that's one that's kind of become, vanilla run-of-the-mill type strategy among income traders. Think of an iron condor. But imagine that the options you're selling have a shorter expiration date than the options you're buying. Boom. That's it. That's it in a nutshell. So it has a couple advantages and disadvantages when you compare it to an iron condor. The advantage is you're selling shorter term options that probably have a higher theta. They don't always, because they're out of the money. Depends how close to the money they are. You got to check. See if you're actually giving yourself the advantage you think you're giving yourself. But you're probably going to get a higher theta. The disadvantage trade-off that you get is you're taking on more risk because they're two different expiration cycles. It's not really a perfect hedge, and if you're not careful, you can end up losing more money than you could with a straight iron condor. So advantages, disadvantages, study it, model it, paper trade it about 20 times before trading it with real money, and you should be good.
And the Condor versus the double diagonal, when you should use those, when you shouldn't. There's some very clear scenarios when something like Iron Condor, or my own personal favorite, the Iron Fly, I like that a lot better than the Iron Condor. People always joke the Iron Condor is the Iron Fly for cowards. I kind of like that. But those types of scenarios are very much contained in one expiration month, as Dan just outlined. So you usually have a strategy there where you're trying to set everything up all in 1 month. You have a particular view you're trying to express. Sometimes it's around earnings or something else, whatever the case may be, and you want to have that all kind of encapsulated in 1 month. But a good scenario when I recently just did this, maybe as a good example for you, when I opted for the time portion of the time Iron Fly, actually, but you can do the same thing, time Iron Condor, time double diagonal, it all works the same. We highlight a lot of unusual activity here at Options Insider, and we saw someone coming in to an underlying, that shall go without name because it's all over the place these days, but someone came in and bought an absurd amount of I think they were about 3 months out, or maybe 2 months out at the time. I'm trying to remember, but they were a few months out, straddles, and just bought a lot of premium out in these months. And they were buying on lifting offers. It was just an absurd amount of buying. What happened there was that just bid up the term structure in that month. So the volatility got very expensive because here comes this very large institutional client just buying this month for whatever reason, going to town, buying up all the options he could right around the at-the-money strike there. So what we saw was a nice little pop there in the term structure of that month really popping up versus the others. And so we also had an event where that underlying was coming up into earnings in a few weeks. And so it became an interesting candidate where we were talking before about trying to exploit opportunities. There was a clear opportunity there to sell some of that premium, whether you're selling strangles or selling straddles. I opted for the latter in the Iron Fly scenario, but you can do the strangles and the Condor, whatever works for you. But maybe you also don't want to do it all in that same expiration month because this activity has just bid up everything around the at-the-money straddle to the point where if you wanted to put on any protective wings like you would in an Iron Condor or an Iron Butterfly, you still would be paying an exorbitant premium. And also, in my case, I really only wanted a very short-term trade. I kind of wanted it through earnings, and the earnings were in about a week or two. So I could go to the front month, 2-week out options and buy those for a much, much cheaper volatility perspective and an overall premium perspective. And now that hedged this trade that I had put on for a ridiculous inflated volatility level and hedged it through earnings. So I was protected at a much more reasonable strike price, is much closer to the strike that I had sold, so I had much more protection from it. And it worked out very well from a diagonal perspective because that's getting back to what we talked about. The real reason you want to do diagonals is to exploit some opportunity. So that is a perfect scenario where the typical Iron Condor or Iron Fly in the same month wouldn't have worked because you would have been stuck with that inflated premium across the board. But if you take the component, maximize the Greeks you want to find in that one particular month, like in this case, the month where that person had bid up that at-the-money straddle and then hedged it with other contracts in other months, in this case, a more narrow-term contract that hedged us through the big gamma concern event, of course, the earnings, then, of course, you had a nice trade that worked out fairly well, and you were able to sell what was essentially a time Iron Fly for, I think, the way this person had bid it up, it worked out to be actually, I think, a couple of cent credit, which is very odd. If you do any Iron Flies or Iron Condors, usually if you're selling it and buying the wings in the same month, you have to pay something for that. You're never going to sell the full amount, whatever it is, a $5 Iron Condor. You're not going to sell it for $5. In this case, this person had bid it up so extremely that it did actually working out to being around even maybe a 2-cent credit. So it's one of those scenarios where you couldn't really pass it up if you're that opportunistic options trader. And so, Mr. Hawkeye, that's one example of when you would want to use those. And that's probably, I think, the ideal example. When someone's created this distortion in a particular month and you want to really take advantage of that with one portion of your Iron Condor trade, or your double diagonal in this case. Otherwise, you should really be content to do those in the same month because those work out very well. And it's much easier, I think, for most listeners to wrap their heads around a 4-legged spread all in the same expiration month. Once you start getting crazy and adding extra months to the mix, it gets a little bit hectic, which is why Dan said this is not the double diagonal and these double Iron Condors, not exactly for the faint of heart. But if you understand what I just said and it makes sense to you, I think why these strategies work will make sense to you as well. And so if you're looking at diagonals and you want to start taking away perhaps the directional component to it, this double diagonal concept, or indeed the time iron fly, time iron condor, whatever you want to call these things, a lot of names that kind of apply to the same scenario. That type of strategy is for you. All right, then. Thank you for that question, Mr. Hawkeye. We have some other good questions here, but we don't think we have time for those because we are running a bit long. But keep the love coming via email or Twitter or Facebook, folks. A lot of great questions on the calendars. I kind of thought that once we got into the calendar realm, we would really set off a firestorm of questions. That certainly has been the case. The double calendars, double diagonals, great questions, guys. Keep them coming. Don't worry, Mr. Richard. We will get to skew sometime in the next few episodes. I don't know exactly where that will fall out. If people keep writing in with time spread questions, we might have to do yet another time spread show just to keep diving into this well, because there's so much to really hit on here. But keep those questions coming. You can find us, of course, theoptionsinsider.com. You can post a comment on this show like a lot of people have done. Find the episode you like, post a comment there. If you're having problems doing that, let us know. We're doing some tweaks to the site to make it even easier for you to do that. Of course, you can find us on Twitter, twitter.com/options, or, of course, Facebook, facebook.com/theoptionsinsider. All great ways to find us, or do it the old-fashioned way. Questions at theoptionsinsider.com. Just be sure to put question for Options Bootcamp in the subject line, and we'll route it to the appropriate show. And that is all the time we have on the show today. But before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Mr. Critchley. I know you guys have been knee-deep in margin land over there. What else is cooking in the land of Sogo? How goes the Great Margin Initiative?
I think we're rolling it out. We're recording on Tuesday, and I think Thursday morning we're going to do a soft rollout. And I've been testing very diligently over the last few days, and not nervous about it, but I'm just anxious for it to get out there and work properly. I'm pretty confident it will, and we're excited about it. And it should really give our customers, more favorable margin, and that coupled with our, very low rates makes it really an attractive place. And the one more thing I wanted to mention was that just be careful, folks, with these diagonals. And again, I just want to reiterate: make sure that you have the verticals down pat, and the calendars, and then the diagonals are like maybe step 3 of this progression. And it was a great show today, and I'm looking forward to maybe having another one on this soon.
Yeah, maybe that should be the progression. Maybe they start off, obviously they learn the at-the-monies, and they start learning verticals, and then maybe they get a little more sophisticated with the verticals, and they take one leg of the vertical and they move it out a month, and they say, oh, let's see how this performs. And maybe you do that in paper trading first, so you don't risk your own capital, and you start seeing, this is how that works. This is what they were talking about, maximizing theta, exploiting different opportunities. Once you start doing that, I think it might make a lot more sense. Or you could just skip to the head of the line and call our friend here, Mr. Passarelli, and he will walk you through all of that himself. Mr. P, what is cooking in the land of market taker mentoring?
Oh boy, Mark, we've got a lot of great stuff always cooking. You may have seen in our most recent press release that we've been doing some work together with a company called Tradespoon. They have a fine product, and we're offering a joint product that kind of goes together. Keep an eye out for upcoming webinars where you have opportunities to listen to us both talk together about the markets and about some of the ways that we together can help you.
Looking forward to that. I just recently met the Tradespoon guys myself. Interesting guys over there, so I'm glad to see you guys have some interesting stuff cooking over there at Market Taker Mentoring and at Tradespoon. And listeners, by the time you hear this, all of the Sogo Trade stuff, if it's rolling out this week, should clearly be up. So surf on over to sogotrade.com. Check out that margin stuff for yourself, all the great margin tools and the increased margin functionality that they're offering over there to make your tools, to make your trading that much more efficient. And on behalf of John and Dan and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and sending in such great questions and keeping Options Bootcamp just rocking it up the charts. So we really owe it all to you. That's the reason why we do this show. So you guys keep those questions coming in. We love them. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.